What's up, everybody? My name is Demetri Kofinas, and you're listening to Hidden Forces, a podcast that inspires investors, entrepreneurs, and everyday citizens to challenge consensus narratives and to learn how to think critically about the systems of power shaping our world. My guest in this week's episode is Daniel Peris. Daniel is Senior Vice President and Senior Portfolio Manager at Federated Hermes in Pittsburgh, and is the author of 3 books that together explore the intellectual underpinnings of modern portfolio allocation with a particular focus on dividend investing, why it's fallen so out of favor with investors over the last 30 years, and why dividend-paying securities are positioned to outperform some of their more growth-oriented, cashless competitors in the next 30. While our recent episodes with Tony Greer and Jeff Currie also focus on the rotation out of growth and into value, the type of value that we explore in those conversations is industry-specific, namely the commodity industry. My objective in this episode is to narrow that focus specifically to companies that pay some portion of their profits to shareholders, irrespective of industry, with the goal of helping you reimagine what is possible for your portfolios and how to manage them in a world of mounting inflation, rising risk rates, and persistently higher levels of financial and political volatility. As most of you already know, Hidden Forces is listener supported. I don't rely on advertisers or commercial sponsors. So the second part of today's episode with Daniel is available to premium subscribers only. You can access that part of the conversation, as well as the transcripts and intelligence reports to each episode by visiting our website at hiddenforces.io, selecting the episode that you're interested in, and clicking on the premium extras, where you can then sign up to one of our premium content tiers. Since some of this episode deals with investing, it should be absolutely clear that nothing we say on this podcast can or should be viewed as financial advice. All opinions expressed by me and my guest are solely our own opinions and should not be relied upon as the basis for financial decisions. And with that, please enjoy this week's episode with my guest, Daniel Peris. Daniel Peris, welcome back to Hidden Forces.
Demetri, thank you so much for having me back.
It's great seeing you, man. I've always told you that you're one of my favorite guests and my most underrated by far guest on the podcast ever. You were in our New York studio a number of years ago for an episode on financial history and the history of financial theory, really one of my favorite episodes. For anyone who hadn't heard that episode, I'd love for you to just start us off with a just basic background on who you are, how you got into finance, because one of the things I love about you is you're such a geek. You have a PhD in Russian history. And when I came to get you, I don't know if you remember this, when I came to get you from the Italian cafe down the street, you kind of put your hand up to me when I found you in the corner. You put your hand up and you just put it up, and then you completed a chess move because you were playing peer-to-peer internet chess. So tell us a little bit about who you are.
I'm afraid you just caught it all and summarized it all. My wife is not as accepting of me putting up my finger and asking her to wait a moment while I complete a chess move, I have to say. So thank you for being tolerant of that. Yeah, I do have some of the kind of stereotypical attributes of a card-carrying professional nerd. And there were times in my life earlier when that was more embarrassing. Now I am proud about it. But as you pointed out, I have a background in history, trained as a historian of modern Russia, very focused on that when I was very focused on that. In my early 30s, with Russia collapsing, maybe we can do another episode on that, and with me facing reality as an adult, married and so forth, I decided it was time to move on, and I left academia and I went into business. I convinced a consulting firm, they'll never make the same mistake twice. What they really, really needed was a 33-year-old historian of modern Russia who had never opened up an Excel spreadsheet before. And they took me on, and I got an on-the-job MBA at air transport consulting firm and made my way ultimately to financial research and then asset management. But my background as a historian never really left me, and I still view myself primarily as a historian who works in the capital markets. And so after I'd settled into the new profession, I both settled on an investment style, which we'll get to, kind of the topic of the podcast, dividend investing with strong historical roots, but also then began writing about financial history and dividend investing, in part because I found that the training, I won't mention the name of the training program, but it's the training program that everyone has to go through to be in the asset management industry. It has an acronym, 3 letters. You get a nice certificate on your wall, a charter, they call it. Really, I thought did a disservice to the style of investing. It was not taught in the canon. And so I wrote a couple books on dividend investing, and I backed up even further in 2018 and wrote a book on modern portfolio theory, and that was the one that you were kind enough to interview me on, probably a year later, 2019, and I came into your studio at that time. And that was I would call it historical appreciation and critique of modern portfolio theory compared to what went before and what need it filled, but what problems it has created, and why investors 60 years later should make sure they understand why they're doing the rules that they've been informed about, told about by their financial advisor, institutional consultant, that they know those rules date from the 1950s and 60s and were addressing a problem that existed in the 1950s and 60s, doesn't exist anymore, but it did then, but those are still the rules that we're investing by. So those books were written in 2011, 2013, 2018, and as an answer to what's changed, those books were written at a time when dividend investing, or the type of cash flow-based investing that I have been talking about, were out of favor. And frankly, they've remained out of favor. They remained out of favor until about a year ago. And so that's what I think I'd like to get to today, is discussing what's changed. And my view of that, we've had it really not just the last decade of a particular style of investing, but really 40 years of declining interest rates. And this is a point that you brought up with prior guests in the last couple of weeks and months, the implications of the end of declining interest rates. There's some other factors as well that I think are going to influence how investors approach holdings in the stock market. We've gotten comfortable doing it one way for the last couple decades. That's been driven substantially by a number of factors, but specifically declining interest rates. As we go forward, investors, institutional consultants, everyone should be looking and saying, okay, this is how we've been doing it for the last couple years, decades. Is this the way we're going to approach our investments for the next couple decades? And I argue the answer is no. Another book is on its way, halfway written out early next year, that looks forward to what I believe will be the next couple decades of stock market investing.
I want to give such a ringing endorsement of your last book, Back to Business. From the jacket art and from the name of the book, you really, I don't think, can gain an appreciation for what's in that book. It is a beautiful tour of financial history with all the colorful flavors and personalities. But then it also, like I said, is a history of financial theory. And for me, that's one of the least understood and most powerful parts of finance, and of sort of helping people gain an explanatory framework for why the world works the way it does. Because all of these different investors are walking around with these frameworks in their heads that they've inherited, and doing a rigorous analysis to understand what went into those theories and how representative or non-representative they are for the world that we live in today is crucial. We're going to obviously cover some of that again as part of this larger conversation of trying to update where we are today from the last time we talked, Daniel, because it was 2019, as you said, and so much has changed since then. It was either 2019 or 2018. Before we do, I have one more question that I'm just very curious about. Like I said, you have a PhD in Russian history. I'm curious how getting a PhD in history has helped you in your career, not just in terms of what you learned from the PhD or from the appreciation that you gained for history, which you may have already had when you went into the program, but also the methodology that you learn. Like, I don't know what that's like. Like, are there things that you learn about how to study history empirically when you're doing a PhD that you're able to actually put into service later in your career?
You know, it's funny. I'll give you an example from what's going on in Russia and Ukraine right now. When you're trained as a historian to think about explaining an event in the past, there are different approaches you can take. You can say it was a structural matter, or it was a collective matter, or that there is agency in history of individuals, and it was Napoleon that moved history. And if you look at Tolstoy's War and Peace, there is the concluding section where he has a discussion of the forces of history. And he says, no, the generals had no impact. It was Kutuzov, the Russian general, is being moved along a wave of history, despite everyone thinking that it is individuals who move history. And as we look at what's occurring now in Russia and Ukraine, so much of my former profession are saying, well, it's Putin that's doing it. No, it's Russian political culture. Yes, Russia supports it. No, this is a wave of, you had Mearsheimer on your show to discuss kind of 19th century geopolitics. And this issue of agency of individuals and what moves history, what creates these events, is being played out in real time. And, armchair historians or professional historians have to deal with this. It's an abstraction when you're describing the Napoleonic Wars and attributing some event to Napoleon or not to. But when it's in your living room and on the news, it's real. It's playing out in real time. And I would say that your podcast, with the name of your podcast, Hidden Forces, and looking at those structures, you're kind of implying that it's behind the scenes factors and structural issues that are important for understanding the financial system that we live in, the political system that we live in. And I think too many finance professionals who are trained in accountancy, in finance, quickly get their MBAs or their CFAs. They memorize the rules. There was nothing wrong with memorizing the rules, but they don't look into where those rules came from and why they were created, and don't question whether those rules make sense. You hear a lot of people on your show and other shows talking about 60-40 rules and asset allocation rules. And so, well, we need to tweak that. That's fine. But a more meaningful question is, well, where did the 60-40 rule come from? What need did it meet at the time it was created? If you don't know what the 60-40 rule is, it doesn't matter. My question is, all the rules that you were presented with as you think about investing or in life, you can ask the question, well, where did that assumption come from? And what I bring to the table, or try to bring to the table as a historian, is to answer that specific question, which is this assumption about Russia, Ukraine, about agency, about historical forces, about finance, about modern portfolio theory, about the capital asset pricing model, about cash relationships between minority shareholders and businesses. All of these have histories. And it is my profound belief that we all make better decisions knowing where our decisions come from. And that too few people in the finance profession, investment profession, simply want to memorize a set of rules and make money. Rinse, repeat, rinse, repeat. And as a dividend investor, someone who's focused on a cash flow-based relationship between asset and owner of the asset, which is out of fashion. To me, it's a natural form of business ownership which exists in the modern world, in the ancient world, in the middle world. And yet it doesn't exist in the US stock market to anywhere near the extent that it should. And to me, that's a historical question. And so that's what I have, my most recent research over the last several years in the upcoming book is in regard to how did we get to the current situation where the US stock market yields 1.5% or so. You have very large, successful companies, don't pay dividends, have no cash relationship with their owners, and that how historically anomalous it is. What were the forces, hidden or not so hidden forces, that created that situation? And how is that likely to play out over the next couple decades?
Man, I'm so excited for this conversation, Daniel. You just reminded me why I enjoy you so much. So a few thoughts came to my head. I'm going to write them out before I ask you the next question. Number one, the last time this happened, where we had a guest on to talk about one thing, but he also had an expertise in international relations, was Jamie Metzel, who had also worked at the WHO. We had him on the show to talk about genomics and genomic science. And in the overtime, we ended up talking about foreign policy. And it was one of those things where I never got to advertise how amazing that part of the conversation was, because the whole point was to talk about genomics. So maybe this will be another Metzel situation, and the full length of the episode in the premium feed, we'll have a chance to talk about Russia, because you're right, I did have John Mearsheimer and Stephen Walt on the podcast, two giants of international relations and the realist school. And of course, so much of John's focus is very much on those structural forces. Well, you could think of them also as endogenous forces versus the exogenous forces of a personality who rises and is actually able to impact history. I'm reminded of Christopher Hitchens' book and his work on Henry Kissinger, and he made the exact same point, that sometimes people do steer the course of history. And Henry Kissinger, he identified as one of those people. Your point about the 60-40 portfolio is also an important one, because the assumptions that underlie that particular strategy derive from a period during which yields on the fixed income side of that ratio were much higher than they've been in recent years. And now we are perhaps on the cusp of a reversal of that 40-year decline in interest rates. So I'm curious how that factors into your analysis and why you think that after having been out of favor for the past 20 or 30 years, that dividend stocks may once again become popular with investors.
Yeah, there really are three reasons why I think an anomalous situation has emerged where large successful businesses do not make profit distributions to their owners. First of all, you never see that in the private world. It doesn't exist. You don't own a business, a private business, without expectations of some share of the profits after all investment needs have been met. And all other stock markets are generally in mature countries, except those that have kind of a similar dynamic to the US. Japan has very low interest rates. Also expect large businesses to pass on their profits to company owners after all of their investment needs have been met. In the United States, it's not the case. And that, I think, has transpired due to a couple of factors. The first and most obvious one is the decline in interest rates. We'll get into why that, because it's a multifaceted reason. There are a number of implications of declining interest rates on how people view their investments in stocks. Second are buybacks. This is something that is a debatable point. Most, if not everyone, in the academy and in finance will disagree with me on buybacks, but I'm happy to have that conversation. And third is the rise of Silicon Valley and a whole different stock market. The stock market had consolidated on the East Coast, and it was what it was. And then NASDAQ arose in the 1970s as a kind of free-spirited California, I'm not going to call it California enterprise, but so many companies arising in Silicon Valley, going their own way, quite some distance from New York. Very, very innovative companies. And I don't want to ever challenge the innovation that arose from Silicon Valley and all of those new companies, but I do want to say that those companies that became very, very successful over time and don't have a cash relationship with their company owners, their minority shareholders, meaning minority individuals or institutions don't own a majority of the company, they own slugs of the company, that it's just anomalous that there is no cash relationship. And I do think that those forces, those hidden and less hidden forces that we've seen kind of in a one-way trajectory over the past couple decades, that they've kind of exhausted themselves. And that over the next few decades, you'll see some balance return where investors insist on a cash relationship. The number one reason for that change is, and this has been a topic that you and many of your recent guests have discussed, is the interest rates. It's not so much that interest rates going up, it's the end of interest rates going down. Interest rates declining for decades have created an unparalleled high level of risk tolerance among investors and, I would argue, corporate managements. When money's free, people behave badly. That's learned in the kindergarten. It's not super finance. But extremely low interest rates allow investors, extremely low hurdle rates, allow investors, corporate management teams to waste money. And investors will tolerate it. And they're willing to do so because asset prices are high and going higher, and they think everything's going to be fine. And the lower the interest rates go, the higher the asset prices can be. And they have substituted capital gains over the last couple decades for cash payments from successful businesses. There's nothing wrong with that. There's been nothing wrong with that. A lot of people have benefited from that wealth creation. There's nothing illegal in it, of course, but it's atypical from a business perspective that you would get money for free, invest it, waste it, innovate with it, do whatever you do with it, and be entirely dependent upon a share price rather than a more business-like relationship with the company owners in terms of a dividend or some sort of cash flow sharing. And again, it's affected, you've mentioned it on previous episodes with guests, how on commodities or how in terms of the dollar, really fascinating episode with Brent Johnson, I believe, on the dollar, the implications of a 40-year trend of declining interest rates.
Yeah, I mean, all those recent episodes have really been really phenomenal to both participate in and to release because I think they're very helpful. I don't think you actually gave a formal definition of what a dividend stock is. If you didn't, I'd love for you to do that. Because I'd also like to draw out the distinctions between a dividend stock and a value stock, because I feel like a lot of people sort of synonymize those two. And then how do we distinguish between those and what we consider to be growth stocks or story stocks?
Sure. So that's a great question. And actually, I hope the SEC is listening because SEC naming rules are pretty liberal. And there's no reason for them not to be illiberal. But I think investors need to understand how these terms are used, whether it's in a packaged financial product or just common sense approach to what different types of stocks that they're investing in. So my axiomatic statement is that a business is a business is a business is a business, whether it's publicly traded or not. And that after the investment needs of a business are met, the owners of the company naturally would share in the profits. That is the case in privately held business. It's most visibly the case for everyone listening to this show in terms of real estate. I actually liken what I do or how I think about the market mostly to real estate. People purchase real estate, they fix the roof, they get tenants, they try to choose a good neighborhood or a rising neighborhood. They put maintenance capex into the building, and then they watch the rents rise. If they've done the job well, the rents rise. If they do the job well, the value of the property increases. But the value of the property is not first and foremost. The rents are. There is a market price for your property, but you don't check it every day. If you need to sell the building or get a check-in for a market price, Zillow is there to give you a price, but you don't check it every 5 minutes between 9:30 and 4 o'clock every day. Instead, you work on managing the business. I happen to view publicly traded businesses in the same way. They're first and foremost businesses, and what values in terms of the success of the business is their cash flows and distributable cash flows to owners. Oh, and by the way, they're publicly traded, so there is a share price. And we access the companies through the stock market. There's nothing wrong with that. It provides daily liquidity. But that approach leads to the answer to your question, which is how do you view a dividend stock as opposed to a traditional value stock? And then we'll get to growth companies in a moment. There is no obligation for companies to pay dividends, and there is no obligation for companies to pay material dividends. But as a dividend investor, dividend-focused investor, I'm looking for a material dividend. Yield of the U.S. stock market's around 1.5%. It has been below 2%, except for periods of crises. And even there, it's a little bit misleading because you're looking at trailing dividends. Some of them may have been cut. It's been below this 2% level for more than 2 decades, started in the 1990s. And I don't consider that meaningful. I mean, you can argue, and there are lots and lots of so-called dividend growth products that have yields of 1.5%, 2%, and they're able to grow the dividend faster than a higher yielding portfolio. But in terms of just having a material cash flow, a net present value that adds up to something, 1.5% just doesn't cut it. And so in the portfolios that I oversee, and as you know, I can't get into details, try to have a dividend yield which has a significantly higher number in gross terms between 4 and 5% of a portfolio, not every security, but of a portfolio. That's before fees. The net present value of a higher yielding portfolio, if you took any of the finance classes seriously, the net present value of a cash flow that starts at, call it a 4% yield versus a cash flow that starts at 1.5% yield is dramatically different. The 1.5% cash flow yield has to grow a lot faster, unrealistically faster, to anywhere catch up with the 4% yielding cash flow. So we're trying to create, and I'm trying to create portfolios for clients that have a material cash flow. In a U.S. stock market, which yields 1.5%, that means necessarily we don't have access to the entire stock market. There are hundreds of companies that don't have dividends at all, and hundreds more that have very low yields. The SEC naming rule's fairly liberal. Again, no problem with it, but investors need to look under the hood. A company that has a dividend meets the SEC naming rule for a product that's equity income or dividend oriented. But it doesn't mean it has to be a high dividend or what I would call a material dividend. So dividend yielding stocks, in a market that yields 1.5%, what's your cutoff? What's the threshold? It can be for anything, whatever you're comfortable with. There are offsetting factors about growth and exposure to sectors and volatility and so forth. But is it 3%, 2.5%, 3.5%, 4%? It can be somewhere in there. I think that's where there's sort of a sweet spot where you can get a diversified portfolio of material dividend paying and dividend growing securities and have a net present value or a cash flow that I refer to grandma a lot, that grandma can live off of, frankly, as a retiree. That is not to say that there aren't really good value stocks out there, but they may not be dividend stocks. And over the last year or two, during the COVID crisis, during various crises, you'll see an opportunity, business cycle, company-specific cycles, you'll see an opportunity to pick up maybe some really good companies on the cheap, so-called value stocks, but they may not have dividends at all or material dividends. I don't have any issue with that. I wish my fellow value investors, I don't really view myself as a value investor, but wish fellow and value investors well in those opportunities. But they are distinctive from a cash flow opportunity where the company does pay a dividend. So again, dividend investing tends to be viewed as a subset of value investing, but it is not a complete value solution.
So one of the questions I want to ask you is, how do you value a dividend stock? But that also kind of raises the question of, how do you value a value stock? And it sounds like a ridiculous question to ask, but in a world where you're comparing value stocks that don't yield a dividend and growth stocks or story stocks that also don't yield a dividend, what does it really matter whether or not the company has good fundamentals if investors have learned not to value those things, and the things that they value are good stories? I'm curious if you thought about that at all. Like, what would make investors actually pay attention to the fundamentals if there isn't a cash flow that they're getting every month or every quarter or every year or every semi-annually that they can point to as a way of valuing the company tangibly?
That's a great point. And I have to admit that my value peers and my growth peers, I think, have to work a lot harder because they don't have an anchor. And the cash flow, the distributable cash flow, is a valuation and common sense anchor that, I'm not going to say makes the job easier, but gives you something to hang your hat on and work on from a valuation perspective. Obviously, the valuation exercises of value investors are looking at cash flows internal to the company. Growth investors are looking at future cash flows. It's fine for both of those, but I am more comfortable, sleep better at night with something that's tangible and available immediately to investors, to grandma, and that is the dividend. So our valuation metrics are not limited to the dividend, but boy, is it helpful to have a dividend to build that valuation metric. It's very hard to get in valuation difficulty. It's not impossible, it can be done, but it's very hard to get into valuation difficulty when you have a cash payment going out the door to the company owners. The valuation metrics, and this is one of the points I hope we get to, is the volatility and valuation ranges, the variances, or to use a finance term, the variances are so much narrower when you're looking at dividend stocks than when you're looking at non-dividend paying stocks. A non-dividend paying value stock can be worth $0 or $100 a share. It's hard to tell. You're going to choose some internal metric and come to your valuation difference conclusion. A non-dividend paying growth stock can be valued anywhere between $0 and $1,000. That's great, much more upside, but you just don't know because there's nothing really tangible there that comes to the shareholder. There may be good cash flows internally, revenue growth, et cetera, but you're making assumptions one step beyond, and valuation metrics one step beyond what the shareholder actually receives. So hats off to an in-the-trenches cyclical value investor because their job is harder. Hats off even more to what I find an almost not impossible, but very challenging job of chasing rainbows and pots of gold at the end of rainbows and trying to value them for the growth investors. So having that dividend up front isn't our exclusive valuation measure because dividends can be at risk. Companies can get ahead of their skis. They can have CapEx requirements that end up being too high. This happens all the time for phone companies, and the dividends can be in risk and so forth. But it's something material and tangible to build the valuation exercise around the DDM, the DCF, the MPV. These are all the key valuation metrics that are taught appropriately in business school and then ignored by everyone, I would argue, except for dividend investors. If you're looking for the discounted cash flow, the dividend discount model, the net present value to the investor, and the company's not making a distribution, then you're in a different realm than looking at dividend paying stocks. Again, it's a harder realm. It may be even a more profitable realm on the way up. It's also a much more painful realm on the way down.
So you mentioned volatility. I think realized volatility has been a lot lower in the last month or several months than many would have expected during such a steep decline in the stock market. One, I'm curious if you have any knowledge of what the historical relationship tends to be between volatility and these types of declines, and whether we've seen this before or what the drivers could be. But the larger point I'm interested in driving at is if we eventually do see higher levels of persistent volatility, which is what you would expect when the Fed is stepping back from holding the hand of the market, how do dividend stocks perform in those types of environments? Because, in large part, so many institutional investors equate risk with volatility. That's one question that I want to ask with respect to valuing dividends. And then I also want to ask, and you can either answer this directly afterwards or we could just have a ongoing conversation about it, and that has to do with inflation and how inflation in a rising rate environment impacts dividend yielding securities. Because I would imagine that rising rates is actually not good for dividend yielding stocks because they then have to compete with fixed income on the one hand. And on the other, I could imagine inflation actually being positive, not just for dividend yielding stocks, but also for incentivizing other companies to begin to issue dividends because the risk of holding onto that cash has increased. It becomes harder to know what to do with it. So better to give it back to investors and reduce the long-term risk of holding cash. So kind of work your way into both of those questions however you like, Daniel. I'm curious what your thoughts are.
Sure. So the first one, the volatility, is really, really important. And again, this is an example in which having a historical appreciation of the stock market matters a lot. If you compare the natural volatility in returns, and again, this is inside baseball to some extent, but it should make common sense to anyone who's kind of measuring things in their own KPIs, whatever those KPIs in whatever profession they may be. But the standard deviation of the return of a dividend stock is naturally going to be lower than the return of a non-dividend stock because a portion of the return is not guaranteed, but it's regular and set and expected. Whereas all of the return from a non-dividend paying stock is the whims of the market, and that historically has been much more volatile. I just got an analysis back looking over the last 32 years of stock market returns, comparing the non-dividend paying stocks in the S&P 500 with the top quintile of dividend paying stocks. And the standard deviation between one and the other, I had to go back and have my quant person double check this, was enormously different. I mean, I'm used to having in our dividend-focused portfolio standard deviation of returns. And my apologies, folks, if you're not interested in standard deviations, but just listen to the differences. Is the standard deviation 11, 12, 13, 14%. The market's standard deviation 15, 16, 17, 18, 19%. That's actually a huge difference, but that's one thing. The non-dividend paying stocks in the S&P 500, you're up in the 30s and 40s and 50%, particularly if you include the dot-com era. And so one of the interesting phenomena that has occurred over the past couple decades is that relationship narrowed dramatically. And this is something I think your listeners should pay attention to for the next decade or two. In the early 1990s, and for periods before then, but before dividends kind of disappeared from the landscape or diminished to a small corner of the stock market, the volatility, the amount to which stocks jumped around dramatically, up or down, for the non-dividend paying ones was much, much greater than the more steady eddy types of returns that you would get from a dividend paying stock. The stock would go up and down, but just not as nearly as much. And one of the factors that I think investors should really appreciate is what's happened over the last decade or two. And that gap has narrowed, meaning people got used to non-dividend paying securities and the volatility declined. Now, a lot of that has to do with declining interest rates. But whereas in 1990, you buy two types of tickets. One's a dividend paying ticket, you know what you get. The other is a stock ticket, no dividend, you know what you get. Huge volatility, great opportunity, great risk. In the last decade or so, the gap narrowed and volatility declined for the FANG stocks. Everyone got comfortable with a very low payout ratio, very low dividends for companies that nevertheless are fairly volatile, new economy companies. One of the arguments that I'm making, and this is where I think investors need to make a decision going forward, is that volatility gap had narrowed. It's going to widen again. And the factor behind it narrowing was the declining interest rates. And one of the leading factors behind it widening in the future is going to be the end of the decline in interest rates. I didn't say the rise in interest rates, but I said the decline in interest rates. In 2022, we're taping this in the middle of, towards the end of May of 2022, we've seen that year-to-date returns in 2022 have shown enormous volatility for non-dividend paying, non-stable business, non-cash flow securities, and lower volatility, not absence of volatility, but lower volatility for the steady Eddie companies, the old economy companies, the revenge of the boring. And I think that volatility gap is something that, unless you have a historical awareness of what happened in the past and why it might change, is something that could catch a lot of people by surprise, unawares. And that's what I'm hoping that investors will come to appreciate, that the current situation, not current 2022, but really from the great financial crisis, say through 2021, was abnormal and unusual in the low degree of volatility associated with very highly volatile businesses.
So what about my point on inflation? The argument that I made, does that hold water? And I want to add to that one more thing, which is that a lot of people listening to this might say, okay, so maybe I can get 4 to 5% on a dividend yielding stock. But if inflation is going to be running at 8 or 9 or 10%, am I just guaranteed to lose money? How can people think about that type of world that we're moving into, the role the dividend stocks play in that situation in order to help you preserve and
Sure.
possibly grow your capital? And are there historical analogies to the 1970s that we can look at?
Sure. And again, everyone's asking, hey, rates are going to rise. Well, what's the experience of your group when rates rise? I said, well, it's a little hard to tell, because the last time rates rose materially was, we don't have really good data sets. It's from the 1960s and 70s.
Also, they rose from levels that were much, much higher than current levels.
And you'll hear market commentators, sell-side commentators say, hey, between May of 2005 and October of 2006 or something, rates rose by 100 basis points. And here's what happened to dividend stocks. And say, that's really interesting, but it doesn't tell me what's going to happen after a 40-year decline in rates and a secular trend either back up or at least sideways. So the answer is we don't know. But my strong suspicion, based on a historical understanding of the market, is risk rates will rise, not just interest rates, but risk rates. And investor tolerance for what used to be called in the 19th century fancy stocks, or what I call rainbow stocks, will diminish. Companies had better have the goods if they want investor support. Specifically to your questions about inflation, I view this as an operating company. And again, I refer back to the real estate, a non-publicly traded asset that people can understand. Inflation hurts. It makes costs go up. It's tough to get labor. We are all of the companies that we own in the portfolio, they're facing labor difficulties just like everyone else is. You're trying to get a handyman or craftsman to fix a roof or a building. Same issue, costs are going up. So it is a front-end cost or gross margin challenge for a lot of companies. And they are shifting over to taking pricing, meaning increasing prices, that's the other side of inflation, to offset that gross margin declines and the higher costs. So on one hand, inflation is a headwind for dividend growth, in effect, and for the operations of companies. It's not a deal breaker for most of the companies. If you're a good dividend investor, the companies you have can withstand bouts of inflation. Many of them are international, global, and they periodically experience inflation in Turkey or Argentina, some corner of the world, somewhere, pretty much every year. So it's not really news for them. It's only news for us in the United States and to some extent in Europe and Japan in the developed markets. So it's a headwind, but it's not a deal breaker. Over time, the nominal dividend growth of the companies will actually move up, but there's a bit of a lag now. So we have, I'll acknowledge, a headwind for dividend growth in an inflationary environment. But really what I address is your underlying question, which is not so much the mechanics of inflation on the cash flows, but the mechanics of rising rates on investor behavior. The first thing I pointed out was rising risk rates. I think investors are going to be more inclined to look kindly upon existing companies rather than rainbow companies. But you also raise the issue that when rates get to a certain point, won't there be competitive challenges for income streams from other types of investments, say fixed income securities or money market funds? The answer is yes, eventually. But remember how far away we are, Demetri, from that level. Interest rates are not at 5% going to 5.5%. They're from 0, 1%, whatever, 2% going to 2.5% or 3%. There will come a time when an 85-year-old grandma will not want to own dividend-paying securities because she can get a 5% return from a money market fund or from her bank CD fund, and she should shift out to that. But it's been 40 years of declining interest rates. We are not there yet. Interest rates are still relatively low. And we'll have that conversation, that competitive conversation, when the time is right. I think more importantly right now is the risk rate conversation where, interest rates are going up. Eventually there'll be a competitive challenge to dividend-paying stocks. But right now, with risk rates rising and these being very stable cash flow-oriented businesses, they're pretty well positioned.
When you say risk rates, draw for me the distinction between risk rates and interest rates, or do you not draw a distinction there?
I do. And risk rates are what's going through an investor's head when they're thinking about to buy a particular stock or a portfolio manager. Interest rates, as we know, and as your guest, Russell Napier, among others, have said, interest rates are subject to a lot of factors. The risk rate or the interest rate that matters to equity investors and is plastered all over the media every day is the U.S. 10-year note. It's so-called risk-free rate for equities. The risk-free rate for bonds is probably going to be a shorter duration, but in terms of the capital asset pricing model, largely discredited, but still used all the time. It's the 10-year note because that's a longer duration. It's fitting with the cash flows of equities, which are longer duration than a bond. So you look at the U.S. 10-year. The problem with the U.S. 10-year, and this has been highlighted by many of your guests over the years, is that there are lots of problems with the U.S. 10-year. Everyone's mucking about with it. It is influenced by the needs of the U.S. Treasury. It's influenced by the Eurodollar market, which is much larger than the U.S. Treasury market. It's influenced by the Federal Reserve Board. It's influenced by the rate on the dollar. And since the financial crisis, it's influenced by direct government intervention. So I think that using the U.S. 10-year as a risk-free rate at the base of understanding risk rates is misleading, and I don't think it's very helpful. So what I say is, or when asked this question, I say, I don't know where the 10-year is going, but I do believe that risk rates are going up. The 10-year contributes to risk rates. The 10-year is just part of the formula. You have then the equity risk premium that's supposed to be added to it, but you can't see the equity risk premium in real time. It's a kind of an academic notion. So everyone just looks at the 10-year and says, well, that's where risk rates are going. Maybe yes, maybe no. But I think after 40 years of declining rates and a growing tolerance for rainbow stocks and fancy stocks, that with interest rates no longer going down, and now we're having a bit of a bubble bursting on in terms of the rainbow stocks, that clearly what we're seeing in 2022 is risk rates moving up. Yeah, interest rates may also move up. We don't know by how much, but clearly risk rates, the investor's expectation for what their expected rate of return must be in order to put this capital out there, an internal rate of return, which is a more technical term, is maybe a better way of looking at it than a CAPM-based expected rate of return or risk, but they're moving up, and interest rates may or may not be moving up with them. And so I just encourage investors to say, am I comfortable making this investment? Yeah, interest rates are still low. That means I can make this investment. Well, maybe yes, maybe no. We shall see. I know certainly from the perspective of a dividend-oriented investor and portfolio manager, we build into our thinking about stocks, individual holdings, how much risk we want, what our expected rate of return is, and it's not using the CAPM model. It's using more absolute returns and absolute expectations. And they tend to be, mid to high single digit, at least in terms of risk rates that we apply to our cash flows.
So I'm glad you brought up Russell Napier because, one, that was a phenomenal conversation.
Yes, it was.
And I highly recommend it for listeners. But he made two separate points in that interview that I'd like to bring up here. One of them has to do with this hypothesis that he put forward around credit rationing and how he expects at some point the U.S. government to draw distinctions between certain types of companies or certain acceptors of credit. For example, the U.S. government and yield suppression. Do you envision that in the world we're moving into, the relative return that one can gain, risk adjusted as well, given the fact that the U.S. government has taken on so much more debt today than it had, let's say 30 years ago, when dividend stocks were more in favor, that the risk adjusted spread between dividend yielding securities and U.S. government debt will grow? That's one question that's sort of thought out loud. I don't know if that makes sense. And then the other observation that Russell Napier made had to do with cost control versus pricing power. And his point was that in inflation, more companies have pricing power, but fewer companies have cost control. And so in the second part of our conversation, we can talk about that as part of a larger conversation that I want to have with you about how to value dividend stocks, what investors want to look for, what areas of the market, what sectors, et cetera. But maybe just answer that one question for me having to do with the spread between U.S. government securities and dividend-yielding securities, and if the conditions are such that we could expect the risk-adjusted spread to actually increase in the world that we're moving into.
Yeah, I think there are kind of two answers to that question. One gets political really, really quickly. And some of your followers on social media and some of the people I look at pretty quickly descend into conversations about very hidden forces that they're upset about financial repression or conspiracies and all sorts of shenanigans. And I don't really have a strong view on that. I find it very interesting, and I share some of those concerns. I may not be as motivated about them. I tend to be bottoms up for companies. If the whole financial system is rigged and it's all coming to naught, it won't matter that a particular company is well run and is relatively inexpensive and has cash flows. It may be the last safe haven, but it won't matter at the end. My biggest risk that I'm concerned about leans in the direction of the rule of law. If you want to see the U.S. market go from a multiple of 20 or 25 times to a multiple of 5 or 10 times, there's a quick political way of doing that. We've spent 2 centuries building up trust systems, also a topic of great interest. It can take just a few days to destroy a trust system and have the stock market look like a banana republic market.
And that might finally be the thing that pushes gold out of its sort of
trading range for the last decade or two.
Yeah, exactly.
And, it's interesting. We can get off topic on Bitcoin as a alternative source of trust, but in fact, the trust factor in Bitcoin and alternative currencies and crypto is just as great. You are trusting all of these computers, all the people who maintain the computers, all the calculations, all the clearing agencies. You've seen plenty of examples of abuse of that mistrust. So ultimately, trust is at the bottom of a financial system. And with the financial repression that Russell Napier talks about, and a lot of people not liking what the Fed has done, trust is sort of at an all-time low. And you see that as a substantial risk. I choose to sidestep that because, frankly, my day job maybe gives me the luxury because I'm not really a macro investor. I have to be fully invested at all time in operating companies that make things. Those companies are struggling with the front end of inflation. The comment about, they can control pricing, they really can't limit costs. The answer is yes. That's what we've seen so far. And actually, pricing takes a little bit while to flow through the system. So that is a legitimate challenge to the companies, but it will be manageable. The companies, if you own a well-run company that makes something that people want, then they'll manage through that. In terms of rates of return versus the treasury market, those lines have crossed a couple times. It does become a macro view, though I think the lines crossed in 1957 where the yield, I have to get this right and make sure I don't get it in reverse. The yield between the what was the U.S. Treasury 10-year, it wasn't a 10-year at the time. The 10-year only came into existence in 1976. But the proxy for the 10-year and the U.S. stock market crossed the lines as we came out of the Depression and World War II. And you had a period of tremendous growth, and the yield of the stock market declined because expectations of growth were greater and were for the next several decades. It reversed again, I forget which year, in the last 20 years, where the stock market yield rose above treasuries. Treasuries came down. Now treasuries have moved back up above. So they're changing position, the yield on the 10-year versus the yield in the S&P 500. Implied in that is an assumption about whether the stock market is going to grow enough to offset the risk of owning stocks. Increasingly, in the last 10 to 15 years, there's a subset of the investment community, many of whom I think listen to your program, who have the additional view that they don't trust the U.S. government as a risk-free rate or as a rate of return anyhow. They may prefer stocks. What's a better credit? Name your blue chip company versus U.S. Treasury. So there's a growing subset of that population. So this quickly gets kind of political and macro. I'm not going to answer that question, Demetri. I apologize. Just because I don't have to, in the sense of from my day job, and I don't have a super view on that. The part that worries me, the middle of the night waking up sweating part, where I find myself agreeing with all the conspiracy theorists, is on the trust side. That the United States, as an experiment in representative democracy and mostly sort of kind of open markets, open minds, is historically itself anomalous, 250 years. And we need to work really, really hard to maintain it. And it is fragile. And all we need to do is look beyond our borders to see other relations, other political relations, other capital markets relations, other business relations. And they may not be exactly to our liking. We have a fairly good thing going. It would be a shame to wreck it.
Yeah, I think what we can do certainly now as we move into the second part of our conversation, Daniel, is to bring in the geopolitical story. But I also want to focus very much on what you look for, how you value dividend stocks, the difference between valuing value stocks and dividend stocks, in other words, that don't issue a dividend versus ones that do. I want to get clear on that because I think that's going to be super useful for listeners. For anyone who is new to the program, Hidden Forces is listener supported. We don't accept advertisers or commercial sponsors. The entire show is funded from top to bottom by listeners like you. If you want access to the second part of today's conversation with Daniel, as well as the episode transcripts and intelligence reports, head over to hiddenforces.io and check out our episode library, where you can also become a premium subscriber today. Daniel, stick around. We're going to move the second part of our conversation onto the premium feed. For more information about this week's episode, or if you want easy access to related programming, visit our website at hiddenforces.io and subscribe to our free email list. If you want access to full episodes, transcripts, and intelligence reports, which include additional notes, resources, links, and other material that will help you get the most out of each and every episode, check out our premium subscription, available through the Hidden Forces website at hiddenforces.io. Today's episode was produced by me and edited by Stylianos Nicolaou. For more episodes, you can check out our website at hiddenforces.io. Join the conversation at Facebook, Twitter, and Instagram at Hidden Forces Pod, or send me an email at dk@hiddenforces.io. As always, thanks for listening. We'll see you next week.